question. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. On Money Friday, this is Your Money, Your Call.
Welcome to Your Money, Your Call. It is going to be a cracker. It's the Bond Show, and we're about to show you something very interesting. Two guys in the bond market who are going to have an argument. They're going to say, I want to buy one, he wants to buy the other. They're not going to agree. It's not like the equity thing where everyone should buy all the equities. They're going to say, I don't like this one and I do like that one. So I'm Mark Todd from the NAB. I hope you enjoyed tonight's show. Should be a cracker. I'm joined by Phil Carden from Supervised Investments and Charlie Jamieson from Jamieson Coote Bonds. They're here to answer any of your questions. Call us on 1300 30 34 35. The email is yourmoney@skynews.com.au. They're both pretty successful guys. They're both playing a different space. Charlie, how have things been with you? Talk to me about that outperformance in a down day and give the viewers a little bit of an understanding about what Jamieson Coote Bonds fund managers do.
Right, so Jamieson Coote Bonds is a government-only bond fund.
At sovereigns?
Sovereigns only.
Sovereigns on my left.
Yeah, and it's been a big week for sovereign markets. We've had a couple of big central bank meetings, which we'll no doubt get into, but we were talking before the show about our performance history as a fund, and so far to date, we have outperformed every market decay period, which is something we're very proud of. I guess government bonds don't move in straight lines, as we know, and as much as we think it's a good...
Just tease out what that decay period means, so the viewers here who
right,
don't
so
buy sovereign bonds.
look, OK, so this week we had Bank of Japan meeting on Wednesday, followed by the Federal Reserve meeting on Thursday, and there was quite a bit of angst about both meetings, potentially, that we might not have as much support for markets from the Bank of Japan, and that potentially the Federal Reserve could hike interest rates. Now, going into those meetings, the markets being very efficient, generally cheapened valuations a little bit, and there was some capital decay in bond prices, which happens every now and again. But it generally happens pretty quickly, which is pretty interesting in the way that the mechanics of the market work. We often talk about the pricing cycle, which is up the staircase, down the fire pole. And if you can imagine, all pricing cycles, equity markets work pretty much the same way. They will tend to grind higher and then release very quickly on bad news or perceived bad news. As it transpired over the course of the week, the Bank of Japan didn't really do an awful lot aside from make some mechanical changes to the way they want to operate their policies, and we'll talk about them in a moment. And the Federal Reserve was what the Federal Reserve has been of late, which is a lot of talk and no action. And so we've had a pretty powerful relief rally in bonds over the last 48 hours, and I think that'll probably continue in the near term.
Now, Phil, you don't buy sovereigns, do you?
Oh,
You're not a massive fan of sovereigns.
We have. Well, I've been trading in the sovereign market probably since about 1980. We did buy a lot of them, but at the moment, no, for good reason.
I'm not saying you don't know about them. That's why the joy of it. I mean, one of the things I want to get out of the show today is the fact that there's a diversity, and I spoke to Chris Joy about it last week. When people, and we're going to talk about the rhetoric of financial market commentary, bond markets become one thing. Bond markets are going to get sold off, and all of a sudden that's just... And I want people to understand there are nuances within all different markets, and if you don't buy sovereigns, I want you to be able to talk today in the show about what you do buy. So you're not in favour of sovereigns at the moment for an array of reasons, but let's talk about your business first and about what you do. So supervised investments do what?
Well, we invest in debt securities globally, and we do it on a relative value basis. And use a risk-return algorithm. So we target risk. We don't go out and say we're going to make X, Y, Z return. We say that we'll take a certain level of risk, which is pretty simple. We don't want to lose any of our principal or interest from the securities we buy. So we'll analyse securities and make sure that they're all going to get repaid. And then we'll buy the ones with the highest yields. So the fund's averaged about 9.5% over the past 7 years, and this financial year to date we're running at about a bit over 8%.
Yeah, right, lovely. The Fed, Bank of Japan didn't do anything. What was your interpretation of why the market rallied? The equity market rallied, everything rallied. How do you read that when the pricing said that they didn't expect the market to do anything. So, you know what I mean? So I don't think you won't do anything. You don't do anything, so I go and buy, I go and rally.
We think that most asset markets, including the sovereign debt market, large areas in the property market and some equity markets are very overpriced because of a very long period of easy, cheap money.
Yep.
And everyone, we think, is scared that the money price will go up because if you look at the core rate of inflation, for instance, in the US, it's 2.5%. The GDP growth there is about 2%. Even Alan Greenspan came out last night and said, well, you know, the US 10-year bond rate could easily go to 5%. So people are scared that when the rates go up, asset prices might drop. But so when they don't, they go, oh, phew, there's a bit more beer at the party here. We can have another drink for an hour or so, and the grog's not running out till 1 o'clock now. Yeah.
Alan's been under the pump a little bit. Like he's been sort of. How would you describe Alan? How history judging?
Probably not that well, to be honest. He blew a pretty large bubble in the end, and it spectacularly blew. And in response, we've blown an even larger bubble on the next watch. So, you know, I completely agree with you. You know, everything.
Oh, don't do that. Come on, let's have an argument. Everything. 3 years I've never had an argument.
Well, no, and I guess when we get through the mechanics of what might transpire, I guess this is where we fall back in love, particularly with Australian sovereign yields, because. Sure, if rates rise, that's not a good thing for any market in the short term, but if it continues, it becomes particularly powerful and we'll get a proper deleveraging cycle. We certainly haven't had one in Australia for a long time. We should have had one in 2007, 2008, but that was masked over by, you know, vicious cuts in the RBA cash rate, which has allowed markets to carry on and we find ourselves, 25 years later without a recession. But arguably, if rates did, viciously rise, and we got 5% bond yields.
Let's talk about that. What Phil's talking about is Greenspan says 10-year US Treasuries go to 5%. Today, folks, are at about 1.6%. So we're talking a massive movement. None of the Fed governors predict that. They think the long-term cash rates will be something like 2.7, something like that. What happens if they go to 5%? Carnage Street equity market.
I mean, it means that mortgage rates are, probably 8%. And let's see how your auctions go tomorrow morning with 8% funding rates. I mean, the world looks very, very different.
No. If the US is at 10, where are we? We'd be 9, 8.
Yeah. Now, look, I think,
If 10 years go to 5%.
10%.
Sorry, if their 10 years go to 5%, we'll travel at a premium.
6.5%.
I think
for our government bonds.
I think we have to be at a
So then our mortgages will be 8-9%.
Yeah, probably.
And we'll be in a global depression fairly soon thereafter, I would imagine.
Well, I think the other point is that if you've got a 10-year bond at 1.5% and it goes to 5%, you're going to lose 31% of your money. And everyone's bought these things for a haven. They want a safe place to store their money while the world's going through a difficult situation. It's actually probably not that safe. I mean, even when you consider if you're an average self-managed superannuation fund retiree who's saved $1 million over their life, and normally you'd go and buy a bond for income. Well, if you do that in Australia at the moment, you get $18,000 a year. You're better off not having the $1 million and going on the pension, which is $20,600 a year.
And if there's carnage like that, I guess there's going to be some challenges around how the government funds all that in terms of those pensions. So there's going to be some social dislocation as well. So there's a question of whether I get my $1 million back in the era of that depression. So it's hard to imagine what the behaviour like, because if you lose 31% of your money on the sovereign bond market, what happens to your equity portfolio, your property portfolio? What happens to the rest of the stuff?
You're in an awful lot of trouble. Now, I think it's just, there's a couple of things to point out.
It doesn't happen that quickly.
It doesn't happen that quickly. And if you hold the bond to maturity, you don't lose anything. So
you'll
have a revaluation.
$18,000 a year as opposed to alternative investments, which are just as safe.
I guess that's why we're seeing the rise of these specialist fund managers, of which we would hope to be included, that can navigate this scenario on behalf of investors. So, last year we managed to put up a 5.5% number. We'll do something towards 7 this year. And you've got to know when to sell these things. I completely agree with that. As we said, the market doesn't move in straight lines. And so you know, if it's very noticeable here to us that inflation is going to rise and the RBA look like they're going to be hiking interest rates, we would get much more defensive than we currently are. But we're a long way from that in Australia.
Now, folks, feel free, you should call us 1300 30 34 35 if you want to talk about this, because this is good stuff. Go on.
I think that's a really good point, Charlie. You know, if you're going to play in the sovereign debt market at the moment, clever fund managers with great track records as you have, that's what you need. Because I don't know how the average doctor or dentist or builder would be able to pick the time to get out of their 1.5% bond before it loses value. So I think that's a really good point. I agree.
Mika, if we can bring up the chart that I asked, it's about the rhetoric at the moment. It's about what you're talking about is finding fund managers that know what they're doing. That's a hard thing to do. Yep, that's the one. And so trying to get the right fund manager is a trick, and maybe that's an okay thing to do. What we've seen of late is some commentary that Charlie's brought in this chart. Do you want to walk through this chart around the hawkish commentary about the rhetoric? Because what I think happens is everyone gets too passionate about the rhetoric, and it's all things are going to end. It's all going to end tomorrow, and everyone should jump out the window. And, you know, some of these disasters, people do jump out the window.
Right, so
what am I looking at there?
This chart is an illustration of hawkish or negative commentary around the outlook for interest rates. And you can see that recently we've spiked to 15-year highs not seen since 2001. So if you feel that the media has been telling you everything about bonds which is negative, you're absolutely correct. The media, particularly the print media, and Mark Todd, of course, you're not in this camp, but the print media last week were in a frenzy about higher interest rates, and I saw one headline saying it was the short of the century. Well, unfortunately, since then, capital prices have improved in 10-year bonds by over 2%. i.e. nearly 130 or 40% of the RBA cash rate in 1 week. So I think you need to be a little bit careful in terms of who you're listening to here, and I think this is classic market psychology. When everybody gets caught on one side of the boat, you know, clearly there's a change in the winds, and you know, the central banks haven't delivered what, you know, I guess the markets were fearful of. And, of course, everybody goes for the door at the same time, and the door becomes a keyhole, and the first few people get out and the rest of them get squeezed. And there's certainly a lot of pain for the shorts in the last week or so.
We have our first caller for the night. I'm not sure who it is. It's a caller. It's June. Hello, June. How are you?
I'm fine, but I'm confused. Everybody keeps talking about getting out of, not everybody, but getting out of the share market and buying bonds.
Yeah.
Right? What bonds are you talking about? Are you talking about corporate bonds, government bonds? Is there a special bond market?
Yep.
Because from what I can gather, unless you go onto a long dated, I'm fairly old and I don't have a super fund. I'm that old. I was too old. We were already out of business. But I'm in the share market and I'm finding it rather stressful, all the volatility.
Yep.
So I was thinking, I would like to buy some bonds, but I don't really know where to go, because if you get the 10 years and 15-year bonds and the capital, I have a couple and the capital's gone down and the interest doesn't seem to cover the capital, and I'm really quite confused. I don't know if it's what sort of bonds you're supposed to, you know, purchase.
Yep. Great. They're great questions, June, and you can email me directly. Not to flog anything, but just to help on the education, and it's mark.todd@nab.com.au. We'll try and answer that question, but we don't know everything about you, so we want to make sure that you have a good experience. If we need to tease that out a little bit further, and we can find an advisor that can try and help you, and we'll give you an array of them. You can try and pick the one that helps. I'll go to you first. When June is saying, I am stressed out by the equity market, been in them probably a long time, the speed of the volatility at the moment is the thing that hurts people, and it's the GFC. It's bang, it's up, and it's all disastrous. When June is told by the media that she should buy bonds, what bonds should June, who doesn't know anything about the bond market, how does she start?
I think June should consider finding an advisor who understands the whole bond market, because there's fixed-rate bonds, which we think are a bit dangerous at the moment for someone like June. And there's floating rate bonds.
Yep.
And I would recommend that June considers buying, for instance, floating rate bonds backed by Australian residential mortgages would be a nice place to start, where she can earn 6-7% in the double B, triple B category. and those bonds will float above the cash rate. As the cash rate goes up, that 6% will increase.
Yep.
And our analysis of those securities, which we analyse every day, the risk-reward I was talking about earlier, indicates that you've got to have conditions far, far worse than those in the GFC before you're going to lose any money on those securities. Whereas your fixed-rate bond, if the interest rates go up, you're going to be in either invested at a very low rate or have a capital loss problem.
Now, June, make a cup of tea, because we have to go to an ad break, and then we'll talk about what we think you should do, so you've got a sense, but we won't necessarily disagree, we'll just expand on it. So, no sugar. Don't do that. We'll be back soon. We'll have a word from our sponsors.
Thanks for calling Squirrel. How can I help?
Hi, I just got my super statement and I'm sick of getting hammered by fees and charges, especially when my fund isn't performing well.
Yeah, we hear that a fair bit.
I'd like to use a self-managed super fund to buy an investment property and rent it out, but it seems so complicated to set up.
Well, I can help you with that because Squirrel makes self-managed super simple.
Really? How so?
Well, for a start, we can get your fund set up right now. We are always here to help and can assist you every step of the way.
I feel better knowing you'll be there if I have questions in the future.
That's what we're here for. Just give us a call if you need us.
With one call to Squirrel, you can take control of your super. Our exclusive online platform and customer support team make it simple to manage your fund.
So that's it?
Yep, all sorted.
Squirrel makes super simple. Call 136 887 or hop on squirrelsuper.com.au now.
Hi, I'm Alan Border. Getting older can make it harder to do everyday things. My legs and feet started to give me trouble. I discovered it could be poorer circulation, so I now use Revitive Circulation Booster.
Revitive uses clinically proven electrical muscle stimulation to actively improve leg circulation, which could reduce swollen feet and ankles.
For me, just one relaxing session a day makes all the difference. I believe using Revitive has really helped me. Try Revitive today with our 60-day money-back trial.
Osteoarthritis pain used to slow her down on holiday. Now she's on the go. This all began with Voltaren Osteogel 12 Hourly.
Applied directly on the joint, it's the only gel that provides pain relief for up to 12 hours. Voltaren, the joy of movement.
There are pots and jars and tubes for your skin, your hair and your teeth. But to help keep you feeling good, my healthcare professional recommended this. A glass of sausage and hospital formula helps you get the nutrition you need for your health. With 27 vitamins and minerals, including calcium for your bones. Plus, it's high in protein. And that helps to keep you strong and active and doing the things you love.
A rental property can be a rewarding investment, but even with great tenants, there'll always be life's unavoidable accidents and uncertainties. Standard building insurance may not cover damage caused by tenants or loss of rent, leaving you out of pocket. Terry Shear is Australia's leading landlord insurance specialist, with award-winning landlord insurance from $1 a day to protect your property and rental income. Call Terry Shear today or go online.
Hello, I'm Peter Byrne. Join me for the B Team this weekend with Brad and Angelina heading for Splitsville. This is clearly the most important news story of the week. So much so I'm beside myself. What are you looking at? I thought I said don't bother me at work.
Welcome back to Your Money, Your Call, the Bonds edition. I'm Mark Todd from the NAB. I'm joined by Phil Carden from Supervised Investments and Charlie Jamison from Jamison Coote Bonds. They're here to answer any of your questions, 1300 30 34 35, and we'll get right into it. So, June, if we can drill it all back, A, it's supposed to be fun. Don't let it be stressful. We don't want it to be stressful. So there's lots of websites. You can start at NAB Trade. You can go to CBA. All the major banks will have videos that will talk to you about the bond market, and there'll be educational videos purely about the bond market. Now, what Phil spoke about is an asset-backed security. So the asset is the house, the mortgage market. So he can expand on that a little bit. A corporate bond would be the NAB would come to market and borrow, and they'll say, look, this is where we'll pay you back. It's a term deposit or a senior bond or a sub-debt. Now, they just did $800 million of sub-debt. So you could lend to the NAB and they would give you 2.4 over the cash rate. That was the number that they paid. There was floating and fixed. So just think about, if I lend to somebody, will they pay me back? That's the corporate you're lending to. Cube was at 390 for sub debt. So think of that. That's the corporates that they're talking about. Charlie, tell me what a sovereign is, and then think about the access, because we all think that June needs to probably find the right fund manager. Look, but takes some time.
First and foremost, June, I think portfolio diversification is really important, and I wouldn't be buying any one security. I think that by accessing a fund, you get obviously access to professional managers that can buy a whole host of securities and generally have a better outcome over time. And if you're finding it confusing, just find a financial advisor that has access to good fund managers and can help you select a fund manager that's appropriate
and can I just
for your circumstance.
Just because I work at the NAB, I mean, I also do a lot of the stuff with the collateral. One thing on NAB Trade is this thing called Meet the Manager. There are videos where you actually get to see the fund manager speak. Yeah, and it's good. We interview that guy and say, well, guy or girl, whoever it might be. And that's a great way of an entry into what they're doing. So you can watch this show, they're fund managers, but that's also another way. And
so we
I
might
know about NAB.
We might run you through the capital structure a little bit of the bond market. And I think it's important to understand this. I guess, first and foremost, you've got government bonds. So you're lending your money to the government, who are obviously running a budget deficit, so they spend more money than they earn at the moment. They need to borrow money from all different types of people and institutions, be they domestic and foreign, and they pay you interest for that privilege. And then, hopefully, they pay you back the money at the end of the bond's maturity. Now, in Australia, we don't really have to worry about that, but certainly in other parts of the world, people have had to worry about that. Then we go up into corporate bond markets, which are clearly companies that want to do the same thing. And this is where we get into some of the risk-return characteristics of the market. Now, clearly, you need to think these things through, because as you're taking more risk, you should be paid more in compensation to do so. And you need to find the right product set, which is for where you are and what you're trying to achieve, and the different liquidity which is available through those different products. So we might let you guys talk about
one of the things to think about also, and before we just belabour the whole point, is that it's harder to buy bonds than it is to buy equities. It's easier to lose money in equities than it is to lose bonds. So there's different characteristics of bonds where you think they're risky. The version of risk that you're describing in the bond market is not the version of risk that's in the equity market. It's just because of where it sits. Does that make sense? Do people understand that, do you think?
Well, I'm not sure. I was thinking, actually, whilst driving down in the car, people will buy equities and they can see the company they're buying, but they're probably reluctant to buy a bond issued by that company because maybe they don't understand that bond. And the fact is that that bond is safer, or is a lower risk instrument than the actual equity, because the equity pays what money is left over after all of the company's
been wound up.
Higher obligations have been paid out,
and
with the best bonds and debts.
Yep.
So bonds are, I guess, or debt securities, it's certainly less risky than equities by definition.
So tell me about the research side of things. We've been talking about going to websites, and the reason why I talk about NAB Trade is because that's the one that I work with. But CBA will have it, Westpac will have it, I think ANZ will have it, I don't know. But there'll be websites that'll have all this sort of stuff. Where do you go and get your research? What's your go-to person theme about how you find out researching markets? What do you do?
Well, we're researching markets that trade over the counter in corporate bonds predominantly, and asset-backed securities, which are securities issued against large pools of assets, such as mortgages. And we get that information from the intermediaries in the marketplace.
Yeah, no, I'm meaning more, not because obviously you've been in markets for a long time, so you can do research on, here's the information, here's the payout structure, you can do all that. I mean, market research in terms of, I think the Fed's going to lift, just that sense of your feel for the market, whether we think it's at the wrong part of the cycle. We're swamped with people trying to scare people through their rhetoric. How do you go about researching just the tone of the market, is what I mean, like whether you want to go long duration, short, that sort of stuff?
Well, it's a mathematical process, and we access data from various data vendors. Certainly read some financial press articles. Look, I think a lot of what Alan Kohler says is easy to understand and easy to digest.
I like Kohler. He's got that Constant Gardener on now. I quite like it.
I think it's a great newsletter.
I think it's a great newsletter. I think it's $25 a month or something. And we're not getting money.
Something like... No,
yeah, we have no...
but I think he's an easy person to understand and a good information source.
And on a Saturday, that's what I remember. That was the question. On Saturday, I get that. I look at what I find interesting, and he's got a lot of different research pieces, and then I think I've done my 40 minutes, my hour, whatever, in the morning, I have my coffee, and then, OK, I've got a sense of what other people are saying. What about you? How do you go about researching your...
Yeah, look, we clearly have an investment process which we believe is very repeatable and has certainly been very good to us over our journey. All of the people that work at Jamieson Coote Bonds have spent a lot of time in international markets, so we look further afield for a lot of our research. We have one of our advisory board members is a quantitative researcher in London who provides great analysis of bond markets and foreign exchange markets for us out of the London and US time zones.
Yep.
We have advisory economist Saul Estlake on our advisory board, so we'll often talk to him about the macro environment. But the investment banks that we do most of our trading with also provide wonderful research and have very robust research departments.
Yep.
And I guess over the course of time you need to collect all of this and then filter out the stuff that you don't like and focus in on the people that you think see the market pretty well and come to your own assessments. But it's not an easy thing to do. I think it's a difficult thing for investors to do from home. To get access to high quality information in real time is tough. And so, I guess it does favour the professional managers to some degree because you spend an awful lot of time reading this stuff.
I absolutely agree, because particularly if you're not dealing in AAA rated or AA rated sovereign debt, which is going to repay you all your money, there are very, very good corporate bonds and there are very, very bad corporate bonds, and the process in identifying the good from the bad is very intricate and requires a lot of experience, on the ground, on the street type experience, but also mathematical acumen and understanding how the cash flows work. So I agree with Charlie. It's a matter of finding a fund manager or a couple of fund managers, if you're interested in fixed interest and debt securities, who have got a good, reliable track record and are in the area you want.
Local fund managers, Australian fund managers, and we're about to go to a break, so question without notice. There are not that many of them.
No.
It's like June. It's not going to be that hard. It's not like you go and find an equity guy. Okay, hang on. There's so many. Yeah. So there's not that many. So I guess there's a question of just trying to work out. I think we've belaboured the point. We've got it done. You've just got to do a bit of research. Don't sell all your equities until you know what you want to do. We'll take an ad break. We'll talk to you soon.
The bag! Yep. Oh, I saw the photos. Awesome.
Well, guess what the best bit of our holiday was?
Oh, that's easy. Jim Falls.
Oh, close, but not quite.
Darwin, Kakadu.
Guess again.
The markets, the Mai Tais, the heli flights, the sea life, the romance, the pit stops, the locals, the larrikins.
Oh, you're like this close.
Gunlam Falls, the watering holes, the waterfalls, the sunsets, the peace and quiet, the sleep-ins.
Stop guessing. Start doing. It's about time you did the NT.
I'm putting some of Nissan's most innovative high-tech cars through their paces.
Get a free auto upgrade on popular Nissan models, like this Nissan X-Trail ST 4x2 from only $29,990 drive away.
Hi, I'm Alan Border. Getting older can make it harder to do everyday things. My legs and feet started to give me trouble. I discovered it could be poorer circulation, so I now use Revitive Circulation Booster.
Revitive uses clinically proven electrical muscle stimulation to actively improve leg circulation, which could reduce swollen feet and ankles.
For me, just one relaxing session a day makes all the difference. I believe using Revitive has really helped me. Try Revitive today with our 60-day money-back trial.
Thanks for calling Squirrel. How can I help?
Hi, I just got my super statement and I'm sick of getting hammered by fees and charges, especially when my fund isn't performing well.
Yeah, we hear that a fair bit.
I'd like to use a self-managed super fund to buy an investment property and rent it out, but it seems so complicated to set up.
Well, I can help you with that because Squirrel makes self-managed super simple. We can get your fund set up right now. Then you can start looking for an investment property.
Really?
Yep, we do all the hard work for you.
With one call to Squirrel, you can take control of your super. Our exclusive platform makes it simple to manage your fund. Our reinvesting money, usually gobbled up by fees and charges, can make a huge difference to your super balance. Squirrel can even show you how to potentially supercharge your returns by purchasing an investment property with your self-managed super fund.
So that's it?
Yep. All sorted.
Squirrel makes super simple. Call 136 887 or hop on squirrelsuper.com.au now.
I'll have the fish and chips, but without the chips. That'll be half price, right? Why isn't everything like pay-as-you-drive insurance, where you only pay for the kilometres you plan to drive, which could save you up to $220?
Search Real Car Insurance.
Holland America Line invites you to write the next great chapter in your life story. A story of classic style and discovery. A story that appeals to all your senses, including your sense of wonder. And you'll do more than just visit great places. You taste, touch, and feel them. Come, savor the journey. Holland America Line's Explore 4 offers are available now. Call your travel professional or visit hollandamerica.com.
Welcome back to Your Money, Your Call. It's the Bonds edition. It's Friday night. I know you're all watching the various football sports, the AFL. It must be starting soon because it does go forever. And the league, I'm sure that's really exciting. So this is probably the replay, and you've probably got dusty heads, but hopefully it'll be entertaining. I'm Mark Todd from the NAB. I'm joined by Phil Carden from Supervised Investments and Charlie Jamison from Jamison Coote Bonds. Just to make sure I get that
Jamison
right.
Coote
I
Bonds.
said it. Jamison Coote
Angus
Bonds.
will be angry if you don't.
Jamison Kook Bonds or Kook. I was just so wrong. Call us 1300 30 34 35. The email is yourmoney@skynews.com.au. The one other thing is Bond Advisor is a website, is a provider of information. I think Nick does a great job on Bond Advisor. So if you need to go on, NAB's just done a deal with them, so it'll be on some of our independent research. So if you want to try and find a research house that can probably collate a lot of this stuff, Bond Advisor is a good one. You can tell them that I sent you and they'll appreciate that. I don't know if they'll give it to you cheaper, but hopefully they will. You know, just tell it came from Mark. How's the market positioned? We've got a chart on how you think the market is set up. The chart is how do equities look on a relative value basis? Do you want to bring up that chart, guys? Oh, they're just looking for it. I think the market's been driven by this zero rate world. It's just rallied pretty hard.
We were looking at it last week, talking to self-managed superannuation fund trustees.
How do I read that, Phil?
Well, what this chart shows you, the orange line is the price of the S&P 500 in the US, which is probably the biggest stock market in the world and the most widely traded, over the life of a baby boomer. So that starts in about 1955. So you can see what's happened to the price there. And the blue lines, the histograms, or the bars, they represent the price-earnings ratio. So what we notice from this chart, if you look at the straight horizontal line, is that most of the time the price-earnings ratio is less than 20 times earnings, i.e. the price of the assets are less than 20 times their earnings. So when they start to move above that line, which is what's happening at the moment, we think they're moving into the danger zone. And why would that be? Well, that would be because nobody can make any money investing anywhere else. You know, we've got 2% rental yields in the Sydney property market. We've got 1.5% bond yields in the good countries. And that's now going to move up above 20, and that's fine if you like risk. And that may move back down below 20 because earnings may improve in the US. I mean, I'm personally positive that earnings will improve in the US in the coming season.
So for the viewers, that number becomes less than 20 because they have better earnings.
Yeah, that's right. So if the earnings go up, the ratio to the PE goes down. So we are expecting better earnings generally. I mean, they've got sub 5% unemployment. They've got, you know, reasonable growth. So the earnings should hold up. There's no major threat there, but still, you're in the danger zone. So I guess the only point we're making there is maybe it's wise to look around for something that's got a bit of income and capital stability whilst that works itself out, particularly if interest rates go up, which everyone doesn't seem to think will happen, but, you know.
You're of the view it might happen. We have our first email for the night. An email. You have any comment on that one?
Look,
sharp, so
I'll leave that to you.
It's an equity thing. So you'll be looking at, what is that stuff?
I know a thing or two about equities, but it's hardly my specialty. But look, I'd agree. I mean, in many respects, zero interest rate policies around the world have driven valuations in asset markets extraordinarily high. That's been to the benefit of the top end of society, and we're seeing an awful lot of unrest around that globally. It's going to make for a very challenging political environment going forward. It's arguably hasn't been a great thing.
Well, actually,
it's been good for investors.
Actually, the new Reserve Bank Governor, I noticed, Dr. Philip Lowe, came out earlier in the week and commented that he felt that the government of Australia could help him out. Yep. We've got very low interest rates. Why don't they go and borrow a whole lot of money and build some productive infrastructure? Yep. Now, I don't think he was talking about pink bats or posting cheques out to people as we saw in the GFC. Yep. He's talking about productive infrastructure that will assist industry, growth and jobs. And, gee, and his reasoning was, look, lower interest rates aren't going to make any difference in Australia. It's probably a demographic issue. Maybe that's the way to go. And I couldn't help thinking what a great start for a new Reserve Bank governor.
I know one of the politicians on that economics panel, which is Kevin Hogan, who comes onto the show. Kevin used to work at the State Bank of New South Wales on balance sheet with, John Pearce, who's now at UniSuper. So Kevin's been around the traps. He went up north and he became a politician, and he's now on that economics committee. And we spoke about this, and one of the things that surprised me was Lowe's openness. He wasn't as guarded as Stevens. He was happily saying to what you've just described. I thought Kevin asked a lot of really good questions around what do you think, because this economics is about infrastructure. The panel that they've got covers tax, infrastructure, banks, because the banks will have to report into them. The thing to think about, though, is that what I was talking to you about, there is a lot of infrastructure going on, and I think what's happened is, and I know Mike Baird is in some trouble, but Mike Baird has done this asset rotation, and that is absolutely massive. So if he says Ausgrid can be sold to an industry fund, which is, for the viewers at home, two industry funds have bid for Ausgrid unsolicited, and I don't know what they've offered. I just saw the headline. He sold $20 billion in assets. He's making huge headway in infrastructure. If he gets another $20 billion, that will be phenomenal. And now you've got people in Victoria
sold the ports for
$1 billion more. So it's not. I hear what Lowe says. I'm not disagreeing with him, but I think the blueprint is these state governments doing the asset rotation and then spending it quickly on the infrastructure to try and get support. Now, Baird might have lost a little bit of support, but you go to Ashfield, you go to those places where these train stations are going, you'll be able to get on a car and go from Newcastle to Canberra. You won't have a red light. What does that do to quality of life? What does that do to infrastructure? What does that do to
productivity?
Productivity. I mean,
sure.
So I think it's actually more around the states that'll be doing it. So
the other thing that's interesting on that, I think, is that clearly we're in this debate about do we want to retain the AAA as a foreign rating, for the Australian rating, and there's concern that we are taking on too much government debt, and that could potentially tip us over the edge. But I do think the ratings agencies have great sympathy if we do really productive infrastructure, borrowing and then spending and deliver on budget to build roads and schools and hospitals and things that generally will deliver much higher internal rates of return than the cost of funding. That's a credit positive event. It means that we're going to have a much bigger pie. So
yeah, we have another caller, and if we have 30 years to build a second airport, that would not be good. So we have another caller, and the caller is, I don't know who, but it's... Hello, Andrew.
It's Andrew. I'm just wondering, where do bondholders stand when a company goes belly up in line for the winding up process? Because just a side issue, when the New South Wales Council invested in those CDOs in America for 2007, 2008 back then, those mortgage securities, I mean, a lot of them were written down to zero, but obviously those houses and that still existed. Like, who actually ended up with the money? There's sort of two questions there, I'm sorry.
That's all right. No, they're great questions, because here is our expert on this asset. So what you're talking about is an asset-backed security. That was question two. And, in the event of a wind-up, do you want to walk us through what happens in the event of a wind-up?
Sure. It's quite simple. You have a number of assets that were purchased into a structure, be it a company or a trust, and let's say they're worth $100 when they're purchased, and they're funded by borrowing money, issuing bonds to the general public. Now then, those assets may drop in price, and they might stop paying their interest obligations, and therefore the company that issued the bonds can no longer pay their interest obligations, so we have an insolvency. The assets are sold.
Can I just slow it down just a little bit? Often, if the company can't pay its coupons, can't pay, the people that own the bonds can trigger the default. They can then say you haven't paid, so therefore the people in the equity or that they force the company to go into receivership. They've got the rights because they have the covenants around when I buy something. If you don't perform, I've got a trigger that I can implement.
That's right. There's events of default written in the trust deed, and they can run to some 200-300 pages. But yes, that's right. Triggers occur. A manager will come in and liquidate the assets and share the money out in order of priority to the creditors.
Yep.
So if there's 50 cents and you've got senior creditors of 30%, so they'll get 30% of a dollar, which will be 30 cents, and that'll only leave 20 cents for the more junior creditors. And eventually you get to the point where people get nothing. A CDO is a very...
Let's talk about that one.
Yeah, well, that's sort of the analogy I'm trying to use because the gentleman asked about that. A CDO is about the most risky sort of asset-backed structure you can get, because what those guys were doing were buying someone else's asset-backed security and then securitising that. So there was someone with some mortgages who issued a bond, and then the guy with the CDO went and bought that bond that was issued by the other mortgage trust, and normally it would be a junior bond. So you've really got some low-quality assets there that won't take much to default, and of course in the GFC they did. I don't think you can buy them anymore. I don't think anybody issues them, to my knowledge.
So people couldn't pay, people lost their jobs, couldn't pay their mortgages, so then the default took place, and the priority meant that the senior lenders got their money, then the juniors, and then all of a sudden the people who had the CDOs, they got nothing.
Well, they were invested at the junior levels of those notes, and there was nothing left.
Yeah.
And interestingly enough, you ask about research, a lot of those were rated, or components of those were rated AAA. And that's why we don't pay any attention to we do our own work when we're rating a bond, because clearly that was a little bit of something that happened in the GFC where you don't necessarily want to trust the
Is
rating
that
agency.
unforgivable? Because he's just decided that is unforgivable. So the ratings agencies have adapted, and Phil's saying, and I think this is GFC phenomena, Phil's saying, I hear you, but because of you made that error, that's a permanent structural shift in my mind.
I absolutely think it's unforgivable. I mean, the fact that this stuff was rated AAA is just appalling, and these rating agencies haven't been hauled over the coals as a result. I mean, there was clearly, very risky structures, based on what was a very toppy asset market, but with poor loan quality, poor documentation quality. And we know what's transpired and the losses that have been transferred onto public balance sheets as a result, and that's really unfair on Joe Average, that now has to foot the bill for these tremendous mistakes that were made, mainly offshore.
Yeah.
But it's certainly resulted in us taking interest rates to unprecedented places globally. I mean, we're now up to 672 interest rate cuts globally since the GFC. We've had one sustainable rate hike from the Federal Reserve. The rest of them that have tried have all cut back to zero very quickly. So
and also the complete distrust in the financial sector and through the advisors, and rightly so. Like I'm not saying anyone shouldn't be distrustful. I'm just saying that it's changed the way people think about their investments, think about the way they pay their fees, think about where they're getting their advice. No one trusts anyone, and I don't think that's recoverable. I think that's just the way it is. We will have our final break. We'll be back soon. You can think about it if you trust us. Keep watching. Don't go to the footy. It's all right.
Trading, the thrill, the excitement, but does it need all the drama? At Easy Markets, we've been constantly innovating for over 13 years, helping traders to make the most of the markets, simply and easily. And now, when the market goes against you, our new deal cancellation lets you instantly cancel any trade within an hour. It's that easy. Give it a go today. Easy Markets. Trading. Pure and simple.
Don't see humans around here much.
That's why we bought a Jeep.
What kind?
Grand Cherokee.
Does that have dual zone automatic climate control?
Yeah.
5-star NCAP safety rating?
7 airbags.
Nice. What'd you pay?
45k drive away.
That's why you bought a Jeep. No photos.
The Jeep Grand Cherokee Laredo. Now from just 45k drive away. Jeep, don't hold back.
Welcome to QuickBooks Online from Intuit. Manage your small business finances with it. It's easy to create an instant invoice and even capture receipts. It's easy to track sales, expenses, BAS and GST. Get started with QuickBooks Online today from just $15 a month.
When it comes to car repairs, Budget Direct customers get a lifetime guarantee on all authorised work.
Good to go.
But not everyone's a Budget Direct customer.
Take it ripping! Woo!
Do you get a lifetime guarantee on repairs?
No!
Get more with Budget Direct.
Osteoarthritis pain used to slow her down on holiday. Now she's on the go. This all began with Voltaren Osteo Gel 12 Hourly.
Applied directly on the joint, it's the only gel that provides pain relief for up to 12 hours. Voltaren, the joy of movement.
There are pots and jars and tubes for your skin, your hair and your teeth. But to help keep you feeling good, my healthcare professional recommended this. The Glasses Sausage and Hospital formula helps you get the nutrition you need for your health. With 27 vitamins and minerals, including calcium for your bones. Plus it's high in protein. And that helps to keep you strong and active and doing the things you love.
When there's hard work to be done, you need more than a truck. What you need is a warrior, a truck that will hold its ground all day. Tailored finance to get you on the road faster all day. And a service plan to keep you going and going and going all day. Fuso is the only truck with the soul of a sumo. Fuso all day.
It's been a disaster. I haven't had any arguments whatsoever. I thought this would be really, you know, fighting fit and they'd get into it, but no. So they want to go and have a drink.
Well, Mark, that's because we both work in different parts of the bond market, and I think as long as you apply the right process and the right filters, we can both generate good returns.
Okay.
Yeah,
it's
fair.
disaster. This is Phil Carden, Supervised Investments, Charlie Jamison Coot Bonds. We're in our final segment, but feel free to call us. 1300 30 34 35. The questions have been great. We have an email, and the email's from Barry. Barry writes. Barry is a regular writer, and we love it up there in Coffs. As I mentioned previously, I like LICs because the fund managers do not have to sell in a panic and can buy at the bottom. Managed funds cannot do this because they have to sell for redemptions on the way down and don't have funds to invest at the bottom. Panics are exactly the time there is action in the bond market. Why don't we see bond LICs? It would be peace of mind to investors like me. Great show. Thank you, Barry, especially for the great show. What do you think?
Yeah, I agree 100%. It'd be great to have some bond LICs for that exact reason.
The premise is accurate. What do you think?
Yeah, I don't disagree. I think, as you mentioned off air, it would be particularly good in high yield, where there is often, you know, we do get scenarios where we'll get very sharp revaluations very quickly, and clearly the bad stuff gets, or the good stuff gets dragged down with the bad stuff, and generally recovers pretty well thereafter, and it does provide wonderful opportunity for people that know what they're doing and what to look for. So I completely agree. I think it would be a really good product to bring to market.
Barry, you've got a good idea.
Even in liquidity events too, and we had one in the leveraged loan markets in the US in January and February, when the bank capital rules caused all the banks to, the new capital rules caused them to sell a lot of their leveraged loans. We were seeing loans down at $40 for bad type of loans, and as low as sort of $75 for good loans. So they've now bounced back to exactly as you said,
performing
back to
assets,
sort of 95. Yeah,
and
well, they weren't not performing.
$40 and $75. What he means is they pay out at $100. So he's not trying to. He's saying that's if they pay their debts, you'll get $100. So at a 60% discount or a 30% discount, if you can do the credit work, there was some opportunities. So it's a good idea.
Yeah.
The problem becomes, let's call it for what it is. You've got to be able to get a listed investment company listed at the right price so that you don't have to spend a lot of money on fees. You know, there is the cost associated with it, and you've got to work out how to do that. And I think it's a great idea, but you've got to have it. It's got to be like 4 or 5. Well, okay, $200 to $300 million.
Oh, I think you'd want 300 to half a billion because of the listing costs.
Because the costs, otherwise it doesn't work. It's too expensive.
Well, I've seen some come on, not necessarily in the bond sector or the high yield bond sector, where 2 to 3% has just come out of that fund.
Because of the cost.
And it's gone on at 100 and very quickly traded down at $97.
Because fees are coming down in your
Unquestionably,
space.
Absolutely.
So it's one of those things where you say, look, I've got to actually perform and get a smaller fee. And that's the good thing about the GFC, all due respect to you fund managers, that there's pressure on fees and it's around performance. So the great driver of those lower fees are the vanguards, the index people.
Yep.
Walk me through it. What do you think? Index?
Well, I'm an active bond manager, so I exist to disagree with indexes. And the reason is it's actually a very inefficient way in many respects to invest. Now, clearly, if the market is in a very powerful trend, it's a low-cost way to access the market. But you've got to remember with index investment that the motivations of the bond issuers and the bond buyers on the other side are not the same. So the way most of these indexes work is that they are weighted by market capitalisation. Thereby, if the government, for instance, in my world, issues a bond, it goes into the index, and the index players must buy it. Whether it's a good or bad bond, they will buy it regardless.
Or equities.
Or equities, or, we're going to find out soon enough if all this high-yield energy debt, which needs to be reissued in 2017, 2018, is actually any good. It's in the indexes, so lots of funds overseas have bought it.
Yeah.
But I'd argue that maybe it could be pretty challenged. So I guess, the reason that we all benchmark our funds against indexes is because that provides the absolute opportunity set of the products that we're investing in. And in order to prove to you that we're good managers, we need to outperform those index. Now, unfortunately, in fixed income, about 87% of managers over the last 3 and 5 years haven't been able to do that. And clearly, a passive indexed matched fund is guaranteed to underperform the index because there are management fees associated with them. But I don't think our fund managers have done a good enough job of being able to outperform that over time. And they need to lift their game.
Is that because the fund managers are just taking that they're on the gravy train and they're not that good? Or is it because it's just that hard, you can't beat the index? Like, what do you think?
Oh, I think it's... No, I think there probably exists so that people with small parcels of money can get access to index-type returns without having to cross huge spreads. I mean, if Charlie's in there, not that you're an index manager, but if he's in there buying $10 million worth of bonds, he's probably paying a spread of 1 basis point.
Yep.
Whereas if I went in to buy $20,000 worth of Treasury bonds, I'd probably have to pay a quarter 25 basis point spread. So, therefore, the fee, in a sense, is justified, but... Look, really, a good manager will manage and seek out value and add value, whether it be within sovereign debt or corporate debt, or whatever the case may be, and their fees should be justified by a performance above any type of index.
Yep.
You can go to the Reserve... we used to go up to the Reserve Bank and buy bonds over the counter.
Yep.
So, why would you want to put it into an index? I agree with Charlie 100%.
Tell me about your thoughts on the way the platforms have changed, the way that now it is easier to buy. The access is far greater for the array of product. I mean, when we were younger, before Carden came along, you couldn't even move FX. So now that platform is, you've got all these FX platforms, you've got everything, right? You've got M funds on various platforms. Is it a good thing? How do you think that plays out over time?
You're talking about investment platforms?
Yeah.
Wrap platforms?
Wrap platforms and all that sort of stuff. How do you see those things evolving?
I think the fee structures, when combined across financial planners, platforms and investment managers, have probably got too high. By the time you pay your planner 1%, you pay your platform 0.5%, you pay your fund manager a 0.5 to 1%, you're getting up close to 3%. You're probably better off trying to find a good, well-managed retail fund or, manage your own investments if you're good enough.
We've got about 2 minutes. The last 30 seconds, or 40 seconds, I want you to try and give the loan market, the scenario of how you assess those loans in the US. Can you tell me what worries you?
There are a few things that worry me at the moment. Clearly, we've got through the central bank meetings, but there's international things coming up that we need to keep a very close eye on. The Italian referendum is coming up. We had a closed session of Parliament to talk about the future of Deutsche Bank last night. There's been some wobbles on around Deutsche Bank. Obviously, there's some litigation from the US that would look like it would wipe out Deutsche Bank's capital if it was successful. And clearly, we've got the US presidential election. We've talked about that on previous shows. You know, the outcome of that, should it be a surprise Trump victory, could really rattle markets pretty powerfully and rattle the dollar. So there's definitely things to worry about into year end.
But everyone be happy. Now, tell me about the loan market in the US, because I know that's something that I wanted you to talk about. So how do you assess these loans? Like, what is it that people are buying?
Well, if you're buying an asset-backed security backed by corporate loans, the way we would assess it is we would go back through history and look at the worst default rates that we've ever seen.
Yep.
And in the recent history, that would be between 2000 and 2003, where we got 7.5%, and then in the GFC it peaked up at 14.1%.
Yeah.
And we would look at the recovery rates in that market, how much money is recovered after that type of default. And they're at about 50%. So we use that data and those statistics to stress the portfolio, how much money is left after those events, and then we take that money and see if it repays our investment.
Give me one loan name. Give me an example of a name that you'd be buying.
OK, well, I'm bidding on one tonight called Zeiss, Z-A-I-S.
What do they do?
They aggregate corporate loans in the US, and then they fund those aggregations by selling notes, senior to junior notes.
As you can see, it's a very complex world out there in the bond market, but it's an enjoyable, and I hope you've enjoyed the show. I want to thank my guests, Phil Carden from Supervised Investments and Charlie Jamison from Jamison Coote Bonds. I'm Mark Todd from the NAB. See you next weekend. Enjoy your footy. Bye-bye.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before